Hey everyone, welcome to this week's Cover Your Ass series. Last week we finished up on the top half of the P&L by talking about other income, and this week we're going to start working our way down to the bottom half of the P&L and talking about a few of the expenses over the next few weeks. This week we're going to start with real estate taxes. It's going to be one of, if not the largest expense line item you're going to see. So it's very important to understand what it is, how it got there, and how to make sure you're calculating it properly. Now, the advantage of the real estate tax line item is that it's by far the easiest number to verify in the entire P&L. You can go right online and see all the real estate taxes paid by all the properties in your county. So there's no reason to not know for certain exactly what the real estate taxes were this year, last year, year before. So you may tell me, why is this included in the CYA series? This is supposed to be about manipulating numbers. If I can verify it, and it's just a fact number, then why would this be a concern for me? Well, I'll tell you why. Real estate taxes, unlike a lot of the other expenses in the income statement, can massively increase upon acquisition. Now, you may look at a package and see what the taxes were today, and just like with all the other expenses, an agent may just take those expenses and put them in the pro forma and say, these are your pro forma expenses. However, real estate taxes get reassessed. So, for instance, back in 2014, someone bought a property for $2 million. Using a rule of thumb, 80%, the tax assessed value at that time was $1.6 million. And so with the millage rate, that works out to about $25,500 real estate taxes. Now, move forward to 2019. That property went from a $2 million valuation to a $5 million valuation that you're buying it out right now. However, at least in the state of Florida, the tax assessed value is capped at a 10% increase per year. So therefore, while the value of the property went up $3 million, the tax assessed value only went from $1.6 million to $2.6 million during that same time. And that $2.6 million is what was charged the millage rate in the taxes you saw for last year at that property. So last year, those taxes, based on that millage rate at $2.6 million, would have been about $41,000. So now you go and buy it for $5 million, thinking, okay, $41,000 is the taxes on this property. And in 2019, even as you own it, that'll be the case because tax assessments are done on January 1st. So this year's taxes will still be fine and still conform with the P&L. However, come January 1st, 2020, you're damn well better believe that the county is going to show up at that property with your purchase price in hand, and that property is going to have a just market value of $5 million. And unlike the previous owner who had the 10% cap, you as the new owner do not have that cap. You start from scratch. So using an 80%, the tax assessment on that $5 million is now going to increase to $4 million. That went from $2.6 million to $4 million between December 31st and January 1st. So now, with that same millage rate, your taxes have increased to $64,000. That's a $23,000 increase in tax. You get no benefit of this. There's no additional revenue coming from this. You have no additional amenities. All it is a drop to the bottom line of a decrease in NOI when those taxes go up. So now you have $23,000 of additional expense, $23,000 lower NOI immediately, because you didn't properly take into consideration the reassessment of your property. Now you may say, okay, I can work my way around that, and maybe you can. However, using a 7 cap on that $23,000 decrease is a $325,000 adjustment to your valuation. At the $5 million purchase price, that means you just paid 6.5% more for the property by not accounting for these taxes. So while these numbers are easy to determine and they're fairly easy to get a rough idea from a calculation standpoint, you really need to make sure that what someone's performing in 2017, what someone's performing in 2018, and even what they're assuming in year one in 2019, because that's prior to the reassessment, is not what you're assuming in the long term, because come 2020 and onward, your taxes could be massively increased if you're buying a property that was purchased a while ago and took the advantage of the tax assessment caps year after year after year until they sold it to you, because you're not going to get that benefit. So make sure to properly understand your real estate taxes, adjust your pro formas accordingly, and cover your ass when you're buying a property. I'll see you next week.